Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Mark Tecotzky, Vice Chairman of Ellington Management Group. Mark, it's great to meet you, so thank you for your time. I'm looking forward to our conversation.
Thank you for having me on. I really appreciate it.
So, you've obviously been at Ellington for some time now. If you look back and think of kind of some moments and what shaped ultimately your investment philosophy and Ellington's approach to credit, what are some of those moments that helped you shape that philosophy?
I think it's experiences that going through shocks to the system, right? So 2008 global financial crisis was a shock to the system. COVID certainly was a shock to the system. You had a little bit of a shock to the system with tariff tantrum in April of 25. But I think it's, I think it was Eisenhower who spoke about the difference between plans and planning. And so plans are worthless because things never go according to plan, but planning is everything because it sort of confers upon you a discipline and an approach that you can hang on to when you see volatility, right? And so we are very, very big on planning and very big on plans. And even though these markets rarely evolve as people expect, every December, all the Wall Street analysts put out, how the market's going to evolve in the next year, and the forward curve is generally not realized, and all that stuff. So, the financial markets are characterized sort of by like reactions to exogenous shocks, right? There's a war now. There's been huge volatility in oil prices. We took over Venezuela. We had volatility around tariffs. So none of those things people could predict or did predict. But I think what's important to us is to have plans and to think about how we're going to manage the assets that are entrusted to us by our clients, how we're going to manage them through different stresses. And it's informed by historical precedent. We use a lot of math, a lot of data science here. We tend to be involved in markets that have the law of large numbers on their side, so things are statistical, and that's what we hang our hat on. And I think what we tried to do is to sort of separate emotions from what our tools for managing cash, our tools for managing risk are telling us. And that is, I think, a critical part of our investment process.
How would you characterize today's credit environment?
So I would say in regards to, so one thing I would say, and we think about this all the time with our clients, is that most investors, whether they're institutional investors or individual investors, when they think about their credit exposure, it's overwhelmingly corporate credit. It's high yield bonds, it's corporate bonds, it's bank loans, right? You're all sort of, all corporate obligations, right? We do a lot of credit investing where you're facing individual investors, a lot of mortgage investing, different consumer finance investing, and so this economy is still 2/3 consumer driven. So I think there's sort of a different a different sense of things on which side you're on. So on the corporate credit side, you look, investment grade companies, their balance sheets are quite strong. You look at like S&P profit margins, they're quite high. But if you get into some of the private credit that's on the corporate side, you have had a few instances, not a lot, but a few instances in the past few years that have been somewhat unnerving, right? You had the subprime auto originator Tricolor, their bankruptcy.
Yep.
You had First Brands in England. You had MFS, and I think all those instances were cases where disclosures given to lenders proved to be inaccurate or inadequate, right? And so when you have news like that you're worried about either the quality of disclosures you've gotten from public companies or their accuracy, it's unnerving because you don't know where that ends, all right? So now for a lot of what we do, it's a different level of disclosure. Like we do a lot of mortgage securitizations, right? Everything's on Bloomberg, and you can see monthly performance data. And you have all the big Wall Street investment banks, JP Morgan, Nomura, Morgan Stanley, Bank of America, with well-resourced, independent, thoughtful research teams that analyze their performance all the time. So I think there's a level of transparency that's been in the parts of structured products where we've been most active that you haven't seen in some other areas of private credit. So I think that the mindset of institutional investors in a lot of the sectors where we're active in is, I think, they recognize housing affordability is challenged. They recognized, consumers have been taking on debt. But I think if you look at the statistics, broadly, performance has been pretty good. And I think if you look on the private credit side, performance has been pretty good too, but you've had a few instances of things that have shaken the confidence a little bit.
Is there any particular areas, within the market today that, you think risk is being mispriced?
I guess we think a lot about transparency and liquidity and the tenor of investments, right? And so I would say, we perceive if you go into an investment that requires you to lock up your money for 7 years, 10 years, right? You're seeing this in the private equity market where return of capital has been very slow, right? So there is a big opportunity cost in doing that, right? If there's an investment like an ETF that's liquid, that you can go in and out of it, versus an investment that might yield a little bit more, but requires a significant lockup on your capital, I think you need to demand a higher return for the lockup on the capital. Not so much that the investment you're making that requires the lockup isn't a good investment. It's just that there are other things that can happen in other markets that might create some really compelling opportunities while you're locked up that you can't take advantage of. Like something might happen in an emerging market there, or the Japanese stock market. And so if you're locked in a vehicle, it represents an opportunity cost that I don't think everybody always prices. And then what I was talking about before is just what is the transparency on this investment, and what sort of objective analysis and tracking of this investment am I going to get by well-credentialed researchers? And a lot of what we do, you get a lot of transparency and you get a lot of objective information, right? Like we're active in the CLO space, right? The CLO space is, you have a long track record there. You have a long history in that market of upgrades and downgrade ratios. And it's a big market, so it's the focus of a lot of analysis. And you get fulsome remittance reports, every quarter on deals with a battery of performance tests, how close, different triggers that govern the waterfall. That level of disclosure and that level of scrutiny and that level of transparency, I think is valuable. But, a lot of times people just, well, what's the yield? Well, what's the yield? And I just think that liquidity and transparency, I think those sometimes get undervalued.
You referenced, a couple of the markets you guys are in: residential mortgages. There's obviously consumer credit, commercial mortgages, and various other structured, products. Is there any particular areas that you think are most attractive in today's market, of those markets, or maybe some I didn't yet mention?
So one thing that is exciting to us about the residential mortgage market now is that you're seeing so there's always been sort of Fannie, Freddie, Ginnie Mae, which are really primarily FHA and VA, as a big part of the credit providers of the mortgage market. And then you've also had private capital in there, right? And that's going back to, the 80s, right? But typically private capital has been only really able to serve either lower FICO borrowers, subprime borrowers, or very large loans, jumbos, right? And that broad swath of sort of median home prices, or, anywhere between, median home prices or 2x median home prices and, 720 to 800 FICO borrowers, those were really dominated by Fannie and Freddie, right? And they've had, incredible, post the financial crisis, when Fannie and Freddie really tightened down their underwriting guidelines, and, all the Dodd-Frank regulations went into place, you've seen absolutely phenomenal credit performance in the U.S. mortgage market. But it's really only recently, in the past few years, where private capital has been serving many of the borrowers that historically would have gotten loans that are guaranteed by Fannie Freddie. And that is a significant change. And I think that's exciting to us, right? If you look at the profitability of Fannie and Freddie post-financial crisis, it's phenomenal. And, their cost of insurance isn't priced like any other standard insurance policy, right? I mean, the cost of insurance from Fannie Freddie is, maybe 30x expected losses, right? It's not like priced like on a regular insurance policy. So for private capital to be able to participate in serving the housing needs of those kind of middle of the fairway borrowers, that's exciting to us, and we've been growing there. And I think that it's also caught the eye of many of the large insurance companies, especially the big sellers of fixed rate annuities. So that's a change that's really started to emerge at scale, 3 years ago, but it's gotten much bigger, right? And so I think that is interesting. We don't have a crystal ball to see how long it persists, but for institutional investors to be able to put capital into that opportunity, I think that's we think there's some really compelling things you can do there.
What about on the commercial mortgage side? Obviously, coming out of COVID, there was all this worry, with office and what is the commercial mortgage market going to look like? Or, smaller banks held in aggregate a lot of the commercial paper. I mean, have we moved past that worry? Where is kind of commercial mortgages, the commercial mortgage market today?
So that's a great question, right? The commercial market really went through its stress between COVID and office vacancies. But then the big, a lot of the loans in the commercial market are floating rate loans, right? So when you had the Fed funds rate go up from like 0 to 5 3/8, that was a huge shock to the borrowing costs on the commercial side. Where on the residential side, the overwhelming number of majority of the loans are fixed rates, right? So, if you were lucky enough to get a 3% or 3.25% fixed rate mortgage, yeah, congrats.
During COVID.
You read about the Fed funds rate going up and the 10-year note goes from 50 basis points to 5%, but you didn't feel it, right? It didn't impact you. You're still writing
Correct.
the same monthly mortgage check. On the commercial side, for they're called CM1 loans, but like for mature, stabilized properties, that was typically a fixed rate loan. But all the loans that are in what's called commercial real estate CLOs or CRE CLOs, and all the commercial bridge loans are floating rate loans. So you had a double whammy stress in that market between office vacancies and then 500 basis point increase in cost of servicing your loan. So what we saw in that market in 23 and 24, when you have a shock like that and you have a stress like that, what we often find is that immediately around that stress and that shock, things are not priced fairly one asset to another, that there is a tendency for the market to sort of treat things as a monolith, right? So what we saw there, we saw, office properties in San Francisco that were being treated as though San Francisco was Hartford, Connecticut, in terms of its, growth potential and diversification of investor base and all those things. So we saw a lot of opportunities there a few years ago. Now, since then, the commercial market has healed a lot, and you've seen big issuance volumes. You've seen a lot of what's called single asset, single borrower deals, and the market acronym for those is SASB, and commercial real estate CLOs, a lot of them focused heavily on multifamily. So capital has flowed in, things have recovered. We'd characterize the market as more fairly priced than what it was before. So we continue to invest there, and we have a lot of mandates that are solely focused on the commercial real estate market. But we don't see, in general, the normal course of business, things we think are wildly cheap relative to other securities, right? It just seems like it's more fairly priced, and that you had a shock a few years ago, and people that were nervous about things, or people that had sort of Armageddon projections for retail or whatever, they've sold their assets. And those were the people that were selling things at levels where it looked like, and it turned out to be, extremely compelling opportunities. And I think one interesting thing there is just how strong retail has been, right? Like, people were writing off retail as dead, because before
Yeah.
Before the concern about office, there was concern about retail, and you certainly had a lot of malls that suffered and didn't make it. But retail growth has been strong, right? This perception a few years ago that everyone was just going to buy everything on Amazon and you were never going to go into store again. It hasn't happened, I think. And you're also seeing it with malls too, right? Like malls that are in good areas are now have remade their business model to become more destination, workout studios and yoga places and more restaurant focused. And so trying to create more gyms, uh, reasons to go to a mall multiple times a week as opposed
Yeah.
to once a month. And that has happened. So I think, these markets are dynamic, resilient. There's creativity to it. So I'd characterize the commercial market as there's certainly been winners and losers, and there's certainly deals that haven't worked out where the keys have gotten mailed back, and you've seen it in the retail, you've seen it in office, but there's been a pretty strong recovery there, and that recovery has attracted capital. So I would say there's no shortage of capital in that space, and we see the market as by and large things being fairly priced. We don't see a real distressed opportunity right now.
What about have you been surprised by kind of the resilience of consumer credit? Feels like, obviously you referenced the basis points jumping up, but it seems that, consumer credit continues to be pretty resilient despite the higher borrowing costs. I mean, what is your
Yeah,
outlook on consumers?
yeah, no, I think that's right. If you look at data, credit card data, auto data, mortgage data, by and large, people are handling their debt loads. I think part of it is a lot of people have had wage grant gains. I do think that there is a bifurcation. So consumers that were fortunate enough to be homeowners, I'd say prior to 2021, prior to the big run up in home prices, if you bought your house 10 years ago, let's say you bought your house in 2016, and you're able to refinance into a very low fixed rate mortgage in 2020 or 2021, what's really happened to you? You've had a lot of home price appreciation, and you've been able to bring down your debt costs. And you compare that to someone who was renting in 2016 and never either want to become a homeowner or couldn't save the down payment or couldn't qualify for a mortgage, or any number of reasons, wasn't able to get into home ownership. That person has seen rents steadily tick up, right?
Yeah.
Whereas the person who bought the house in 2016, refinanced it in 2020, they keep seeing wage gains, right? So one big metric of creditworthiness in the mortgage market is debt to income. So basically, how much money do you make, and how much are your bills every month?
Yeah.
Your car loan payment and your credit card and your cell phone bill, all this stuff, right? And your mortgage payment. And so those borrowers, they're looking really good. Their income's up a lot from 2016, and they've lowered their debt costs. Now, I'm sure they're paying a little bit more for homeowners insurance, paying a little bit more for, if member of HOA fees and condo fees, things like that. But they're in good shape. And then if you add to that people that have been fortunate enough to have had investments in the stock market, the S&P or the Nasdaq or whatever, they've had tremendous gains, right? And so we definitely do think there is a bifurcation between consumers that have been homeowners and have a low fixed rate mortgage and have been able to, in part because they've had a low fixed rate mortgage, been able to allocate 401k or other money into the stock market. Their balance sheets are looking really strong. Whereas if you've just been a serial renter and haven't had the luxury of some excess cash to put into the stock market, it's been much harder because you're faced with, higher costs for everything, right? Higher
Yeah.
costs for gas, for food, for rent, everything. So people talk about this K-shaped recovery, K-shaped economy.
Hmm.
You'd certainly see that in the data. So I think for all these things, like, you have to be really specific. So by and large, the consumer is doing well, but then if you peel back the onion, there is variability within that for sure.
Yeah. Before you referenced obviously the locking up the money and the premium you get for that. How would you characterize kind of the relative value versus securitized versus unsecuritized? And for those that are willing to lock up their money,
Hmm.
do you think they're getting enough of a premium? And part of this question is related to your question, to your point on transparency. Like it feels like more transparency is going to private markets. Is the premium being eroded a little bit due to that, or are they still getting enough premium for that lockup of their money?
Yeah, I guess what I would say is that we don't typically think about things um, between private and public or 144A. We tend to think about things in terms of what's the expected return,
Mhm.
how liquid is it, how transparent is, and then importantly, how is it going to perform in a bad environment, and whatever a bad environment for that asset would be. So what is the downside risk, right? We think a lot. Our worldview is that we don't have a crystal ball in the future. We make conditional predictions, right? So we think we understand how certain mortgages prepay if in different rate environments, how consumers are going to pay on their mortgage, based on changes in home prices and unemployment rates and that kind of thing. But we acknowledge that the really big shocks are things we can't predict. COVID,
Yeah.
the current war. And so if you're willing to tolerate the angst that goes with saying the future is unpredictable and I'm going to invest dollars given that unpredictability, then you start thinking about different scenarios, right? And so we'll think about housing investments in terms of home price shocks. What happens if home prices go down 5%, 10%, 15%? Same thing with commercial real estate. What happens if real estate values go down, if cap rates go up? We think about CLOs in terms of changes in corporate default rates. And we look for investments where the return looks compelling now and we can live with the downside shock, right? So we tend to not be involved in things that have sort of very binary outcomes unless the skew or the probability of upside is in our favor. And then when we make those investments, we size them appropriately relative to the funds because, you know, something that has an 80% chance of working out great and a 20% chance of being a disaster, that can be a good investment depending on how it's priced. But
Hmm.
no matter how it's priced, it can't represent too big a portion of your fund because the 20% thing can happen or the 10% thing can happen. So in terms of private versus public, I guess where we are is there are lots of assets that start as private and then become public. Like we are a very active securitizer of mortgage-backed securities. So we're buying loans which are private, and then we're securitizing them and making them, 144A eligible, so liquid. And I think so. So to me, that distinction isn't so much specific to the asset. It's more into whether it's been packaged or securitized. Same thing with loans, right? You take bank loans and then you put them into a CLO, and you've converted it from private to 144A. It's public, but I think what's interesting about securitized products right now is to carry it one step further. Now, if you put it into an ETF, right now you've expanded the borrower base because you take a high net worth individual who might have money in a money market fund, right? AAA CLOs are floating rate assets. They're roughly, 125 over SOFR. They have a long track record of very strong credit performance. It's an asset that makes sense for a lot of high net worth individuals that have money in money market funds. and want to put some of that money in money market funds, they'll tolerate a little bit of net price volatility and pick up 120 basis points in a CLO. But some high net worth person isn't going to buy an individual AAA CLO. But now all of a sudden you have these CLO ETFs come about. Like the biggest one is from Janus J AAA. And
Yep.
wow, that's magic, right? It's this big $30 billion ETF. It's diversified across lots of names. It has the perfect liquidity of a stock. You don't have to lock up. You can see where it trades within a penny every second of the day that the markets are open. And I think what that does, that brought a lot of incremental demand to the sector, right? Because it packaged a fundamentally good asset class, a AAA CLO, into a form that appealed to a lot of people that the asset class made sense to them, but it was in a form that they couldn't access, right?
Yeah.
Now they can access it. So I think that trend is great for investors. I think it'll continue. I mean, you look at these ETFs, the transparency is great. Publish their holdings every day. Everyone can look at them. Everyone can vet them. You have great liquidity. The fees for the manager are relatively modest. I think so you can take an asset, a bank loan, starts as private. Now it's in a CLO. Now it's 144A. So it's liquid for institutional investors, but it's not liquid for individual investors. Now it goes into an ETF. Now it's, just like buying a mutual fund or just like, buying spiders, right? So that is, I think that'll be a bigger part of securitized products. Securitized products have a lot of yield if you can tolerate some cash flow uncertainty, right? And you look at I think that was kind of the aha moment for a lot of the big insurance companies that do annuities, right? Where they were living in a world of kind of investment grade corporate bonds and treasury bonds. And both those things, you have absolute certainty of your cash flow, right? If you buy an investment grade corporate bond from Walmart or Microsoft or whatever, barring a default, to the penny what cash flow you're going to get in the future, right? Same thing with the treasury bond. Now you go into something like a mortgage, you give up that cash flow uncertainty. You give up that cash flow certainty, but you can pick up 130, 100 basis points over these other sectors, right? And so the point is, if you're an insurer and your liabilities are uncertain, why do you need to pay up so much for cash flow certainty? Cash flow certainty it's not valuable if your liabilities are uncertain. So that's been a big sea change in insurance company balance sheets in the last 3 years, that I will tolerate some cash flow uncertainty on the asset side, and it's acceptable to me because I have cash flow uncertainty on the liability side, but I'm getting a yield pickup. And so it's not about taking credit risk, or it's not about down in liquidity. A lot of times these things are up in liquidity and up in credit. It's just tolerating not only cash flow uncertainty, but also, a certain degree of negative convexity. So sort of call risk, but in terms of yield. And I think that for a lot of individual investors, that trade-off will make sense too, right? I have a 2-year treasury bond. If I could buy a 2-year mortgage bond that yields 125 basis points more, and it's not exactly a 2-year, but it's kind of a 2-year-ish, it's probably worth it.
Earlier, you referenced, kind of your analytical approach to investing. Kind of, how do you think about differentiation when it comes to credit modeling and the way that you guys look and use data?
I think as a management company, you need to invest in it, right? So you have to be willing to have a big data budget. And we have a big research team, right? Which are, PhD level people, statisticians, people training in physics, and lots of really brilliant people that were focused on STEM as undergraduates, right? So you need to invest in it, and so you need to invest in the data, you need to invest in the people, but you need to then apply it to the right sectors, right? It can be misapplied. So mortgages are the perfect chemistry experiment for it, because You have lots and lots of loans. You have data going back to the 70s from Fannie and Freddie. And importantly, you have data going through shocks, right? You have, what happened during the financial crisis, what happened in 2022.
Yep.
When you're investing in sectors that haven't gone through a shock, you're extrapolating about how bad things can get as opposed to interpolating. And there's a big difference in accuracy. So with mortgages, I think it's the perfect place to have a big data spend, have a big research spend, really hone your models, and really use them to help you investing. I think, but what you have to do is when you have shocks to the system, you need to, keep focusing on your North Star of data and shocks and recognizing that you are investing, in a probabilistic way, right? And that in a probabilistic way, shock's going to happen sometime. So I think a lot of times we see when there's a market stress and you have forced liquidations, right? So the market stress and someone who came into that stress very highly levered might be getting margin calls from repo lenders, and they're a forced seller, right? And when you have forced sellers and forced liquidations going through the system, prices get to places you cannot believe. It's like jaw dropping, right? Now, so then in that market, what you have to realize is, wow, here's an asset that now all of a sudden yields 400 basis points more than what it yielded a month ago, right? And maybe the fundamentals haven't changed much. So this looks like a great investment. This investment yields 14% now unlevered. So boy, if I own this thing for 3 years, I'm at 40+% return, right? I know with a high degree of certainty, buying this asset now that's fundamentally sound, it's just had a big drop in price because there's been forced selling. 3 years from now, it's going to be a great investment. But you have no certainty as to where that thing's going to be tomorrow. It might be down another 5 points, right? So you have to have the right kind of capital. You have to have the right kind of investors that understand that opportunity set and is willing to tolerate that. But, the best investments come at times of stress, and they come when other market participants are doing things for uneconomic reasons. They're not selling some bond down, but at 30 points because they have some insight into the bond. They're doing it because they have to. And you saw a lot of that during COVID.
As technology and the use of technology, even AI, becomes more and more, kind of applicable across, these different markets, how do you think about kind of the balance of the technology and what that can do and the human who ultimately, can make the final call? But, how do you think about the balance of the two as technology and the ingestion of technology and what AI can do with it continues to develop?
It's a great question. I don't know where it ends, right? Like I think what I think about is that the AI models we're using now seem pretty darn good. They're the worst models we're ever going to use, right? They're just going to
Yeah,
get better.
exactly.
We're using it a lot to automate processes, to make our processes more robust, to be able to, consume, large PDFs, help us analyze them. So it's been a great help to us in those regards. We have not used it in a way to inform where we're making investments, right? So we haven't said, I'm the AI model, I think you should sell out of this sector and buy this other sector. We're using it to analyze those sectors better, hopefully, but we still have our chain of command for decision-making processes hasn't changed. It may change, and I do think that there's a lot of emotion in these markets, and emotion probably gets in the way of investment returns. And you've seen it you see some of the big pod shops, right, where it's very formulaic. If you have a certain drawdown of certain magnitude, you cut your position by X. A bigger magnitude, you cut it by Y. I think all that stuff is done to take emotion out of things and to I think their expectation improves the investment process, and it may well be right. I guess for us, we always need to think about is when you're looking at models, is the historical record, is it missing anything that's relevant about the moment right now? Like it's interesting. We have a new chairman of the Fed, Warsh. We have a press conference yesterday. The market responded with a lot of volatility. When you go back, even 6 months from now, and you look at what the long bond did at a certain day and what the 2-year did, right? It's just going to be, it'll look like a strange day, right? And you won't necessarily go back and connect it to the narrative of what happened that day. And I think that we have to challenge ourselves when we're using models, when we're using history to predict what's happening going forward. We have to always challenge ourselves, is it relevant? So one thing with AI I think is interesting now, and Morgan Stanley had a big, very thoughtful research piece they put out last week or the week before last on AI and what they think it can do to make consumers more efficient about how they handle their finances, how they're going to manage their mortgage, maybe about how how they manage their checking account. And so they're going to be, I think, AI tools that will take the emotion out of investing for consumers, right? And I think that could be a very big change too.
Do you think, I'm always curious I've been asking this more lately. Do you think AI is a bigger investment opportunity, like data centers and the
Mm-hmm.
like, or is it a bigger impact on processes and how you ingest data? Like, which one is the bigger impact long term?
I mean, they're both big, right? You look at the capex now going into AI, and you
It's
look at
crazy.
what it is relative to all U.S. capex. It's a big number. Um, in terms of productivity gains for employees, how it changes how code is written. These are massive changes. So I just think I think you don't know yet. I do think this though, like there's going to be a realization that many things people want AI to do, you don't need the most cutting edge model, right? Like they talk about how it's going to shop, right? You're going to say, okay, hey, Claude, I want to buy a 24-ounce stainless steel water bottle. What's the best one to get? And bing, 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 it'll show you something, it'll order it for you, right? Now, you don't need the most cutting edge AI model to do that, right? So I think there's going to be some recognition that what model you need, what model you should be using, what you should be paying for is going to be a function of what your use case is. Right now, it's like people just want the uber sophisticated, but people are going to look at the cost of this stuff too. And like many people, most use cases probably don't require the most sophisticated model.
If you think about if we're starting to look forward a bit, um, where do you see some of the greatest opportunities for innovation across structured finance and alternative credit?
I think for structured finance, if I look at things like Tricolor and First Brands, I'm hoping that being able to process more data will can be used as an effective fraud detection tool. Like one thing that's been part of the mortgage market since since the start of it was inaccurate appraisals or appraisal fraud. So I think some of these AI tools and more data can be helpful there. And what was the last part of the question?
Just in terms of the greatest opportunity for innovation across either structured credit or alternative credit.
I think I think there are opportunities, like I was saying, like there are opportunities for tools to help consumers be more efficient and more thoughtful about handling their finances. And like your finances, it's such a fraught topic for many investors, and it creates anxiety, or I'm not
Hmm.
efficient. I don't want to look at this, that, or the other thing. I think that like there's opportunities to help people make better decisions in a lot of these areas with AI tools, and sort of, the same way like it's made shopping for airline tickets totally different, right? It can
Yeah.
just it can just help you. It can kind of democratize, best processes.
If you think, you know, um, 3, 5 years ahead, are there any emerging asset classes or structures that you're particularly excited about over the next few years?
Look, this data center build out is that's getting to be a big market, right? Like
Yeah.
overnight, that gets to be a big market. It's not the kind of thing we normally get involved in, but that could certainly change. I mean, the potentials are so enormous. The potentials for healthcare, for education. I just think we have to. We don't know where it'll wind up, so we just need to be open minded. And I think what we have to do is not put any artificial limits on it, or not reject it out of hand because you're concerned about how it can change staffing levels. I think it has potential to create so much opportunity, and can create, it can limit the importance of certain jobs, but it can spawn many other jobs. So I just think you have to be open minded, and you can't be a luddite about it, right? Like it's pretty incredible.
One more question before we get close to wrapping up with some fun questions. If you could give an institutional investor one piece of advice about navigating today's market, what would that be?
Be patient, right? That markets go through cycles, and the opportunity set tomorrow is going to be different than the opportunity set today. So if you're going to allocate a certain amount of money to a market, you can kind of scale in. Like I said before, don't just look at headline yields. Think about what's the downside risk and what's the liquidity. I think all that stuff is really important. And and make distinctions between asset classes where there's a long historical series, and you can see how they've done in market stresses, versus newer asset classes where you don't have that same degree of confidence that you really have guardrails around performance in a stress.
So I always like to end with some fun questions. Favorite sports team? And if you don't have a favorite sports team, then hobby, or if you want to give me both.
Well, favorite sports team, New York Mets.
Ah, you're
Hasn't
an
given us a lot
unfortunate
to
Met
cheer
fan
about.
with me.
Yeah, yeah, definitely.
Tough year. Tough
Hobbies,
year.
hobbies. I love the outdoors. I love nature. I love to kayak, to bike, just hike. Nature. Just it moves me. It fascinates me. I love it so much.
One surprising thing about yourself.
Oh God, I don't know. That I'm doing a podcast.
All right, there you go. One book you'd recommend reading.
Ooh, I'm gonna go with The Waves by Virginia Woolf. I think it's just such a interesting take on how sort of people's internal lives really are.
Most exciting part of your job.
I like working with the clients. I like, like we have so many clients that have such important missions, you know, either in healthcare, education, or obligations to pay retirees that were teachers or firefighters or whatever, just to work with them, understand their constraints, and then use the many talented people here and the hard work we do to help them accomplish what they need to accomplish. That's continually inspiring. That's always inspiring.
And then final question, always one prediction for the next 12 months.
Oh, geez. Um, my prediction is that the market will begin to question more seriously what the payoff will be and the duration of the payoff from some of this AI CapEx.
And
You're
then
seeing it now a little bit.
I'll do a quick added question. Will we have baseball next year?
Oh, I didn't even know that was a question. Why wouldn't we?
Well, because they're going into a labor disagreement.
Oh.
Yeah, the owners want a hard salary cap. The players won't go for it. And the thought is we could be going for a lockout.
Oh, I hope not.
Me too.
I hope not, because
too.
you know what? As good as AI is, it hasn't disrupted baseball yet, right? So,
well, that's a good place to end it. Mark, I really appreciate you taking a few minutes to come on the show. Thank you,
Todd.
and continued success to you and the team.
Thank you very much. Appreciate the opportunity.
Yep, thank you.
Bye-bye.
Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.